My name is Jake, welcome to the channel. In today's video, I want to talk about the best dividend growth ETFs for long-term investors, those of you looking to retire off of your dividend growth portfolio. I've been creating YouTube videos for about 4.5 years, and I have not made a video like this in over 4 years. So I thought it's probably about time to make an updated version of this video. So in this video, I'm going to tackle a couple of different topics, and I really want to show you hands-on kind of what I think about as a dividend growth investor, someone who's living off of his portfolio today. I'm going to share with you some things that I think about these type of ETFs, especially if you're one of those people out there that are trying to build a dividend portfolio that you can one day live off of. Because let's be honest, not all dividend growth ETFs are created equal. Some companies in these indices, some of them grow and some of them don't grow. And when you invest in a dividend growth ETF that is not actually growing, it cannot go to plan, and it might look a little like this.
It's like boom, headshot.
Oh my gosh, good times, good times. All right, cool. Before we dive into this, I want to take just a moment and I want to talk briefly about Charlie Munger. Charlie Munger had a huge impact on my life, and I think for many of you as well. Charlie Munger, for those of you who do not know, was kind of the second-hand man to Warren Buffett. And one of the most impactful quotes that I recall from Charlie Munger that impacted me personally, and I still remember to this day, the feeling that I had when I was listening to this. But in an interview, Charlie Munger was asked, what is the secret to a long and happy life? And his response was this: you don't have a lot of envy. You don't have a lot of resentment. You don't overspend your income. You stay cheerful in spite of your troubles. You deal with reliable people, and you do what you're supposed to do. And all of these simple rules work so well to make your life better. And they're so trite. Let go of negative feelings. This quote really resonated with me, and I just wanted to share it with you. So first off, I want to talk about what makes a great dividend growth ETF. And there's a handful of things that can make a great dividend growth ETF. And the first thing is the underlying index. What is the index that this ETF is tracking? Because at the end of the day, when you invest into an index, you're getting nothing more than what the rules are of the index. And when you invest into a passive index, not an actively managed, right? So very, very different. Active is actively managed, a fund manager is buying and selling actively in the market, whereas a passive index just follows the rules of the index, okay? And all of these ETFs that I talk about, they're all rule-based and they're all passive index, hence why their expense ratio is so low compared to actively managed funds. So the four that we're gonna talk about, the first is VIG from Vanguard. This is the Vanguard Dividend Appreciation Index Fund. The second is from Schwab, the SEHD High US Dividend Equity ETF. The third is DGRO. This is the iShares Core Dividend Growth ETF. And then the fourth is DGRW, the Wisdom Tree US Quality Dividend Growth Fund ETF. I've made videos on all of these ETFs, and I will leave a link in the description of this video. If you would like to do a deep dive into these ETFs, you can click on the videos in the description below and you can check out, the ETF that interests you. There I go into very lengthy detail on what the index is, how it's set up, everything from A to Z, everything that you would need to know. But for the sake of this video, I really want to take a little bit of a step back and a bigger picture when it comes to this topic. So all of these ETFs, they're all US based. They're all very, very tax efficient. They're all with reputable issuers like Vanguard, Schwab, Schwab, Wisdom Tree, iShares, all of their inception date have been, they're fairly recent. They're not really, really old. The expense ratios are low. This is probably one of the most important things that I look for is the expense ratio, the assets under management, what is the liquidity, or how popular are these ETFs. At a glance here, the highest expense ratio is DGRW, whereas the others are, closer to like a total U.S. stock market, like a VTI or a VOO for the S&P 500. But if we go down here and we take a look at the total returns, the total return is the capital appreciation plus the dividend. When you go on, Google or Yahoo Finance and you take a look at the charts, you're only going to see it with the share price, not with the dividend reinvested. So it's very, very important that you use a website like Seeking Alpha or something similar where you can see the total return. This is really, really important, especially if you're a dividend investor. This matters so much more, in my opinion, because dividends absolutely matter. Okay. So anyways, when you take a look at this, you can see that the highest performer since January of 2015, you can see the highest performer is DGRW. Now, one thing that I think is important, you don't want to fall trap to recency bias. Just because DGRO has really, really outperformed this year, it doesn't necessarily mean that will continue every single year, right? So there's something that's called the reversion to the mean. Over a long, extended period of time, stocks and ETFs, they revert back to their, historical, price to earnings ratio. And that's important to understand that. Okay, so just because one is outperforming today doesn't necessarily mean that it will always continue. But I don't know. Who knows? I don't have a crystal ball. Anyways, you got DGRO here, and you got SHD, and then you got VIG. So these are the four ETFs that we're going to take a look at, and they're pretty different. Okay, with VIG, just to kind of give you a headline of the differences here, VIG is looking at companies that have increased their dividend for at least 10 consecutive years. Whereas with SHD is tracking companies that have paid a dividend for at least 10 years, not consecutive, okay? And then DGRO is looking at companies that have increased their dividend for at least 5 years, okay? So you're going to get, with DGRO, with that, you're going to get quite a bit more, but you probably would expect more turnover, okay? And you'll see that if you watch those other individual videos if you want to learn more about them. DGRW is the kind of the odd one out here, where it doesn't look at historical data, it looks at future looking data. What is the future growth, earnings per share growth, dividend growth of these companies, as just kind of an example. So where these three look at historical data, DGRW is forward looking, and it kind of sets it apart from the others. It's a very, very unique ETF, but once again, you're paying a higher expense ratio. Okay. But over the last, since 2015, despite that higher expense ratio, you've gotten a higher total return. So you could argue, is it worth it? Is it not worth it? But that's for you to decide. These are the ETF grades. You will need Seeking Alpha Premium in order to view this. And if you want to sign up to Seeking Alpha Premium, if you use my link, you'll get 30% off instead of the the full price. You'll get it for $167 with an additional free trial. So if you're interested in that, I will leave a link to this in the description below. So these are the different grades, and this changes obviously as the market comes and goes. Last year, SHD was A's across the board. SHD does focus more on a higher dividend, right? And that's why, in 2023 here, high dividend stocks have been under pressure, but as we know, the market works in cycles. And then this is really the thing that you want to focus on when we're thinking about, or what makes a great dividend growth ETF, is you want to focus on the dividend yield. But what I like focusing on is the 4-year average yield, because if you're dollar cost averaging into your portfolio, this is the reasonable yield that you're going to be receiving as you invest on, on a biweekly or a monthly basis. As you get your paycheck from your 9-to-5 job, this is what you're going to reasonably expect, unless you're lump sum investing. Okay. And this is another thing that you're going to take a look at is the dividend growth rates. The dividend growth rate is how quickly they're growing their dividend. So a higher dividend growth rate well, obviously you're going to have a higher dividend yield in the future. But this is where the time horizon kind of takes place here as well. If you're going to be retiring in the near future, you want a higher starting yield, but you're going to sacrifice a little bit on the dividend growth. And then if you have a longer time horizon, you're going to want to reverse that, vice versa, where you're going to want a lower, starting yield, but a higher dividend growth rate. Okay, so that's what I'm talking about with kind of that ratio between the dividend growth and the starting yield. And depending on who you are, that's what you want to understand. And personal finance is unique for everyone. Everyone's in a different situation, and it's important that you personally understand what your goal is so that you can invest or build your portfolio so that it meets your goals. Now it's important to understand real returns versus more, nominal returns. And if you didn't go to a, business school or you never took an econ class, it's really just comes down to what is your real return, and it's adjusted for inflation. So when you think about a return, you have to adjust it based off of your expenses, or in this case, inflation. And so when you're thinking about retiring early from your dividend portfolio, you want to make sure that your income, the growth of your dividend, is growing and it's outpacing inflation so that you're getting a real return. This is why if you invest into these covered call ETFs or these meme ETFs, that you may actually be doing yourself a disservice, because over the long term, you may be actually losing, having a negative return in terms of inflation, okay? So when we think about real returns versus nominal returns, interest rates can be expressed in two ways: as nominal rates or as real rates. And the difference is that nominal rates are not adjusted for inflation, while real rates are. So as a result, nominal rates are almost always higher, except during those rare periods when deflation or negative inflation takes place. So right now we're in a deflationary time period where inflation is coming down. It's spiked up, even though I wouldn't necessarily agree that inflation is coming down, because my eggs only are going up, my insurance is only going up, but I'm being told that it's going down. So, okay, whatever. I'm not an economist, but I can only say from what I'm seeing. But anyways, that's a whole nother topic. You want to make sure that your investments are growing, and you're seeing the importance here with inflation. So when it comes to inflation, it's important that you understand and know your history, that inflation in certain time periods, it's been more volatile than others, right? Here, luckily, for those of you that are maybe in your 20s or 30s, we really haven't experienced, hyperinflation like our parents and grandparents did years ago, right? You see these massive swings up and down. Thankfully, we haven't really had to endure that for the majority of our lives, right? For those of you listening to this and watching this video. So historically, inflation has been right around 2.5%. And so when I think about projecting future inflation, I'm usually going to use around a 3% to be conservative. So if we were to project, okay, what is inflation going to look like in 10 years? So that, that dozen eggs cost what, $5, $6 today? Well, what is it going to cost in 10 years? So in 10 years, if we assume an inflation rate of 3%, it's going to cost about 34, 35% more in 10 years than it does today. And so let's say you're in your 20s or your 30s and you plan on retiring, here in 20 years. Well, you're going to need, right here, you're going to need about 80% more than what you do today. And this is why, you getting the picture here? This is why growth is so important. And if we look at this from a 30-year time period, you're going to need, for every $100 that you spend today, to buy the same amount of goods, you're going to need $242, estimated in 30 years. So that's why when you think about, dividend investing, you want to make sure that you're not just focused on the current yield, but that yield is growing. Otherwise, you're not going to see a real return. You're going to see effectively a negative real return because of inflation. All right, now let's take a look at the yield on cost comparison of each of these ETFs. Now, yield on cost is a beautiful thing. And if you're not sure what it is, if you're a dividend investor and if you don't understand this, listen up. This is so important. Yield on cost is what your initial yield is when you purchase a stock. So let's say today you buy $100 of Procter & Gamble and it's yielding 2.5% as an example. Your yield on cost with that purchase today is 2.5%. Let's say in 5 years, they've increased their dividend every year by 5 to 6%. Well, your yield on cost is no longer 2.5%, but it's 2.5% plus those additional increases. So that is so important. And every time you dollar cost average into your portfolio, you're adjusting your yield on cost. Every additional dollar that you add, whether the yield be higher or lower, you're always adjusting your yield on cost. And it's important, this ties into the growth, that you're investing into ETFs that are actually growing and rewarding you as a shareholder with a growing dividend. So how can we take a look at this? So just as an example, if you were to lump sum invest, I can't calculate this by dollar cost averaging, but if you were to lump sum invest 5 years ago into VIG. Let's say you invested $1,000 into VIG 5 years ago. If you would have done that 5 years ago, your yield on cost would be just under 3%. So that's the example with VIG. Let's take a look at DGRW. Using the same example of 5 years, if you look at DGRW, the current forward yield is 1.85%. If you would have bought it 5 years ago, almost exactly the same, it would be just under 3%. Okay, so 3%. And if you were to go back, just as an example, 10 years, you're yielding 4.5%. That is the power of dividend growth investing. Okay, now let's take a look at another example with DGRO. With DGRO, you're getting a little bit of a higher starting forward yield at 2.5%. But if you were to look at this at 5 years ago, you're getting a 3.5% dividend yield on your initial yield on cost 5 years ago. Now, this is obviously going to change and adjust based off of when you buy, right? So for example, if you bought during the pandemic, you're obviously going to get a higher yield versus if you were to buy it during times of, higher valuation. So timing of this does matter. Obviously, it doesn't impact it, but that's just to show you the power of the growth that can come with investing in dividend growth ETFs. Now let's take a look at kind of the prime example of why everyone loves SEHD. The forward dividend yield of SEHD is 3.5%. This is an absolute dream, especially if you have a fairly short time horizon. But you take a look at this, the yield on cost over the last 5 years, you're getting just over a 5.25 yield on cost. If you would have invested 5 years ago. So this is the power of yield on cost and power of dividend growth investing. And these ETFs, the longer your time horizon, the higher that initial yield on cost will be. And that's why, once again, understanding your investment time horizon is so important. Now let's take a look at this with a dividend reinvestment calculator. This is a calculator that I created that you can use for free. The link is in the description below. There's no paywall, there's no Patreon, you don't have to pay for it. This is my gift to you. This is a calculator that I like because it differentiates between the dividend and the capital appreciation. Most calculators out there don't distinguish between the dividend growth, and it can be a little bit funky if you're trying to single out the dividend and what the dividend growth would look like, okay? Now, in my previous video 2 weeks ago, I showed an example of what it would look like with a portfolio with SEHD and DGRO at 50-50. In this video, I want to show an example of what it would look like if you followed the simple path to wealth with dividend investing. You had a core and satellite approach where 40% is in SEHD, 40% is in DGRO, and 10% is a satellite in DGRW, and 10% of a satellite in VIG. And all of this fun shenanigans, I did all of this. I spent a good amount of time prepping for this, making sure all the math is correct. These are all numbers from November of 2023. I did all of the calculations for you. If you appreciate this, well, here you go. I hope that you appreciate it because I put a lot of love into it. So anyways, these are the numbers. I did this all for you. These numbers right here, This is with a portfolio allocation of a 40, 40, 10, and 10. These numbers right here, you will tie in to the numbers up here, and I've done it already for you. And if you wanted to play around with this and say, for example, maybe 10% into, Coca-Cola or Pepsi or whatever, right? A different ETF, you can play with the numbers and you can adjust it. The formulas are all there for you. But anyways, what would this look like if you were to invest $10,000 lump sum and then $1,000 a month into a portfolio like this? Now, I know that $1,000 a month is not going to be feasible for everyone. I understand that. If you're not investing $1,000 a month, that's okay. If you can only do 100, if you can only do 500, 300, do what you can do. Okay. And this is what you're going to take a look at and what you're going to see when you run the numbers here. And so that you can see this a little bit better, I'm going to pull this over here. And let me see if I can zoom in a little bit so you can see it a little bit better. So this is what you're going to see. This is just the dividend with the calculations or with the, the parameters here or the variables up here above. If you were to invest $1,000 a month into the portfolio below, after 10 years, you're going to expect about $7,000 in annual dividends. After 20 years, $41,000. And after 30 years, you can expect around $200,000 in annual dividend income if you set it and forget it and you invest into a portfolio like the Simple Path to Wealth. Now, these are, based off of historical numbers. And I get that. I understand that, right? So if you want to be more conservative, you want to lower these by maybe 0.25% or 1% or 2%, whatever, you can do that. Be my guest, right? This is based off of historical numbers. I know that they're never guaranteed. These are market cap weighted indices. So, as companies come out of favor, new up and coming companies replace them. So it's kind of that survival of the fittest. I don't know what's going to happen, but this is how I project this. Okay. So if you were, let's say, for example, you're like, Jake, this sounds great. I can do this. And then you think, okay, well, what can I do more? How can I, get this to work even better? Maybe I should re-engineer and add maybe one or two more different companies or one or two more ETFs. Now, if you're one of those who are maybe a little bit younger or thinking that you're going to time the market and you're going to pick stocks and come in and out of the market at the perfect time, and you're going to somehow turbocharge this and make it faster, you can try that. But my recommendation to the overwhelming majority of those of you watching this video, if you really want to grow your net worth, and you want to grow your wealth, and you want to do it kind of similar to what I did, if you really, really want to move the needle and you really want to make this work, I would highly encourage you, don't think about trying to buy in and out of the right stock or the right ETF and play the game. You're not Wall Street, okay? The best thing that the average person can do to improve this is not focus on buying at the right time and selling at the right time. The best thing that you can do, if you have the foundation, I'm giving you the blueprint. This is the foundation. If you have this, the very best thing that you can do, your average person who went to public school, who didn't get fed with a silver spoon, I'm talking to you. The number one thing that you can do is focus on this. If you can somehow go from investing $1,000 to $1,100 to $1,200 a month, if you can move this, if you can increase your amount invested ever so slightly every year or every other year, this is how the average person builds wealth in America. If you have the foundation, the blueprint, right, like you have, if you can do this if you can somehow manage to work an extra shift at work, side hustle, do something on the side where you can generate a little bit more money, or cut your expenses. Maybe you go out to eat one day less a month. I don't know. If you can double that, if you can increase your savings rate so that you're investing a little bit more, this is how you build wealth in America. If you can do this, if you can somehow lower your expenses, stay out of consumer debt, and somehow manage to invest a little bit more every month, this is how you build wealth. Well, everybody, this is the Simple Path to Wealth with Dividend Growth Investing, inspired by J.L. Collins. This is the core and satellite approach to investing that I talk about on my channel. If you want to really move the needle and build wealth, You got to focus on the basics. See where you can cut your expenses, stay out of consumer debt, and see where you can make a little bit more money on the side so that you can invest a little bit more every single month. Thank you so much for watching, everybody, and I'll see everyone in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.